So you've got your eye on a luxury property, and you've probably heard the term jumbo loan thrown around. Well, for 2026, the entire game has changed in a way we haven't seen before. If a high-end home is in your plans, you are definitely going to want to see this. Let's dive right in.
For as long as I can remember, the logic was pretty simple, right? A bigger loan means more risk for the bank, so it must mean you pay a higher interest rate. It just makes sense. But what if I told you that in 2026, that common sense is completely wrong?
Yeah, take a look at this. For the first time in a very long time, the numbers are telling a totally different story. The average rate on a jumbo loan is now lower than a standard conventional loan. We're talking 5.85% for a jumbo versus 6.19% for conventional. Now, that might not sound like a lot, but over the life of a big loan, that's tens of thousands of dollars. So the real questions are, why is this happening? And more importantly, how can you get in on it?
Okay, to really get why this weird market shift is happening, we first have to be super clear on what a jumbo loan even is. And it all comes down to a single, very specific number.
You know, in the simplest terms, a jumbo loan is just a mortgage that's too big to be bought or guaranteed by government-backed groups like Fannie Mae or Freddie Mac. And that right there, that's the key. There's no government safety net. The lender is taking on 100% of the risk, which is exactly why they get to make their own much, much tougher rules.
And here it is. This is the magic number for 2026, $806,500. If you need to borrow even $1 more than that, congrats, you're officially in jumbo territory. Now, keep in mind this number can be higher in some super high-cost areas, but for most of the country, this is the line in the sand.
So, how do you actually get that lower rate? Well, it's not easy. Lenders have basically set up 5 major hurdles you have to clear. You can think of them like 5 gatekeepers standing between you and the best financing in the luxury market. Let's break them down one by one. All right, first up, and you could argue this is the most important one of all, your credit score. This is the lender's #1 way to gauge how responsible you are with money, and believe me, for a jumbo loan, they are expecting absolute excellence.
And your score has a direct, massive impact on your rate. To lock in that amazing 5.85%, you really need to be at 760 or higher. If you're hovering in the 720 to 759 range, that rate creeps up to around 6%. And if you're below 700, it's going to be really, really tough to get approved at all. The takeaway here couldn't be clearer. A higher score isn't just a nice to have, it's your direct path to saving a ton of cash.
Let's move on to the next hurdle. Once your credit is rock solid, lenders want to see that you've got some serious skin in the game. And that, of course, means a big down payment.
If you want to unlock those best-in-class rates, the industry standard is 20% down. So, for a $1.5 million home, you're looking at bringing $300,000 to the table. Sure, you might find some lenders who will do it for 10%, but they'll almost always make you pay a higher interest rate, which kind of defeats the whole purpose of what we're trying to do here.
Okay, hurdle number 3 is all about your cash flow. Lenders need to feel totally confident that this huge new mortgage payment isn't going to stretch your finances to the breaking point. And the way they measure this is with something called your debt-to-income ratio, or DTI.
So here's how it works. It's actually pretty simple. You just add up all your monthly debt payments, so that's your new mortgage, your car payment, credit cards, everything, and you divide that total by your gross monthly income, what you make before taxes. So in this example, you've got $7,000 in debt on a $20,000 income. That gives you a DTI of 35%. Now, while the absolute max they'll technically allow is 43%, what lenders really want to see is 36% or lower. That's the sweet spot.
Hurdle number 4 is all about what happens after you've closed on the house. Lenders need to see that you have a safety net. They want proof, cold, hard proof, that you have enough liquid cash left over to handle a financial emergency without ever missing a mortgage payment.
And they're very specific about this. For a loan up to $1 million, you need 6 months worth of your total mortgage payment just sitting in the bank. As that loan gets bigger, so does the requirement, all the way up to a full year of payments for loans over $3 million. Think of it as their insurance policy against you losing your job or having some other income disruption.
And that brings us to the 5th and final hurdle, proving where all this money is actually coming from. Lenders are going to put your income under a microscope to make absolutely sure it's stable and that it's going to continue for the foreseeable future. What this really means is you've got to provide a deep, documented history of your earnings. If you're a W-2 employee, that's 2 years of W-2s and your recent pay stubs. If you're self-employed,
Get ready to hand over 2 full years of tax returns, profit and loss statements, the whole shebang. And hey, if a big chunk of your income comes from bonuses or commissions, you have to prove a consistent 2-year average. They leave very little room for ambiguity here.
So we made it through the 5 hurdles. Phew. Now let's put it all together and do a direct side-by-side comparison of a jumbo loan versus a conventional one for 2026. This is where you can really see the trade-offs in black and white. And the story this table tells is pretty stark. Look, conventional loans are just more accessible. They have lower credit score minimums, you can get away with smaller down payments. But the reward for meeting those much stricter jumbo requirements, that 700-plus credit score, the 20% down payment, is huge. Not only do you get that lower interest rate, but you also get to completely avoid paying private mortgage insurance, or PMI, which is a massive, massive advantage. All these percentages and ratios are great, but what does it actually mean for your bank account? Let's translate all of these hurdles into the one number that I know everyone really wants to know. How much money do you actually need to make per year?
Well, using that 36% DTI ratio that lenders love so much, we can get a really clear picture. To comfortably afford a $1 million home, you'll need to show an annual income of about $180,000. For a $1.5 million place, that jumps to $270,000. And if you're aiming for that $3 million dream property, you're going to need an income of over $500,000 a year. This makes the goal pretty concrete, doesn't it?
And this really brings us full circle, explaining exactly why this whole weird, amazing opportunity exists in the first place. The logic is actually quite simple. Because of all those hurdles, jumbo borrowers are, by definition, the most financially sound, least risky customers a bank could ever ask for. And in today's market, lenders are fighting tooth and nail for these premium clients. Their number one weapon in that fight? Offering a lower interest rate.
Look, the requirements are steep. There's just no doubt about that. But the reward is crystal clear. A lower interest rate on what could be the home of your dreams. You've seen the hurdles. You've seen the math behind it all. So the only question left is the one right here. Is 2026 your year to make that luxury move?